LLC is not a lock on the door. If the windows are open, it does not matter. A lot of business owners and real estate investors believe that once they form an LLC, they are protected. They move the property into the LLC. They open a bank account. They save the operating agreement. Then they move on. That feels organized, but that does not mean the structure is aligned. And that is where the problem starts, because your LLC is only one part of the structure. The rest of the house still matters. Here is what happens over time. You buy another property. You refinance. You sign a personal guarantee. You update your estate plan. You change how you want assets to transfer if something happens to you. But the LLC never gets reviewed. The paperwork sits in a folder. The business moves forward. The structure stays frozen. That is how risk builds. Not because the LLC is bad, because the LLC no longer matches reality. Let me give you the simplest example. The building may be inside the LLC, but you may have signed the debt personally. That does not mean the LLC was pierced. It means you created a separate personal obligation. That distinction matters. A bank guarantee can put you personally on the hook, even when the asset is titled inside the LLC. Then there is the estate plan. Your trust may say one thing. Your LLC operating agreement, which is the rule book that governs the LLC, may say another. Then your tax return may tell a third story. That is not a plan. That is conflict. And this is where many owners make another mistake. They confuse an LLC with an S-Corp. An LLC is a state law entity. An S-Corp is a federal tax election. You can have both. An LLC can elect to be taxed as an S-Corp if it qualifies and files the proper election. So when someone says, I have an LLC, so I have a tax strategy, that is not enough. The real question is, how is the entity taxed? Why was it set up that way? Does the tax treatment match the business? Does the legal structure match the estate plan? Does the debt match the ownership? That is the structure test. Here are the 5 questions every owner should answer. First, who owns the property? Second, who owes the debt? Third, who controls the entity? Fourth, who receives the asset if something happens? Fifth, do the legal, tax, and estate documents agree? If those answers point in different directions, you do not have clarity. You have drift. And drift does not usually show up when everything is calm. It shows up when something forces a review, a refinance, a sale, a dispute, a lawsuit, a death, a family transition. That is when everyone opens the folder. That is when the deed, loan documents, trust, operating agreement, and tax returns all get compared. And that is when people find out whether they had a structure or just paperwork. Most owners do not need more entities. They need the structure they already have to be aligned. Property by property, loan by loan, entity by entity, document by document, tax, legal, estate, all in the same conversation. The goal is not complexity. The goal is consistency. A good structure should be clear enough that your family does not need to guess what you meant. An LLC can be powerful, but only when the rest of the house is closed, because a locked door does not help if the windows are open. If you own real estate or operate a business and have not reviewed your structure recently, comment strategy, and we will walk you through how a full structure review works.